Economist at PGIM, and she joins me now from London. I look at these and I'm staggered. Monetary policy normally operates at glacial speeds. When I look at what we've got here, it's quite remarkable how, particularly, let's take Norway's gone all the way up to 2.25%.
Yes, it is. Here today in the UK, the Bank of England raised rates, and perhaps the Bank of England is a bit of an exception to the pattern that you've just focused on. We saw them raise rates, as I expected, by 50 basis points. This is the 7th consecutive rise that we've seen coming from the Bank of England. It's part of a very proactive stance that they took. They were one of the first central banks out of the gate, tightening policy, already talking about raising rates at the end of last year, and indeed stopped purchases of government bonds. So they were one of the more proactive and early and consistent responders. And so far, we haven't seen that ratcheting up coming from the Bank of England.
Two things on these numbers that we're seeing. That we have Jay Powell yesterday basically saying higher for longer. Don't get any idea we're going to be pivoting and turning back. And we have a sort of a hardening of expectations. So how far down this, and I know, individual countries will have different measures. How far down this road do you think we are?
It's very difficult to say because of a number of factors. Firstly, we have been hit here in Europe by a huge energy shock. That shock happened. It started already in the last few months of 2021 and, really took full effect on February 24th when Russia invaded Ukraine. And the real economic impact of that shock has yet to really materialize on the real economy. And it is very difficult to assess, how impactful that is going to be. So that is one area of uncertainty. If we focus here on the UK, we have a new government. We don't yet know details around this fiscal package that we're hoping to hear more about in the coming days. And so that too will have an important impact on where a policy needs to be set optimally.
Katharine, do you think this fiscal package, which is an interesting one because it seems like it's going to be broad-based, we know that the heating, the fuel plan is broad-based and very expensive, but these tax cuts, I mean, you heard what, you probably weren't listening to, you weren't with us by that stage, what Christina Georgieva of the IMF says. What's the point of raising rates to tighten policy if at the same time government and fiscally is doing broad-based tax cuts, which loosens policy?
Well, the Bank of England is very much hoping, I expect, that its early and proactive stance at raising rates will allow it now to thread that needle, if you like, to strike that balance of being able to demonstrate resolve that it is committed to its inflation target and bringing inflation back down to 2% without having to over-tighten and magnify the downturn on the real economy. But that said, the impact of these rate rises is meant to weaken the economy, to bring demand down in order to bring inflation back to target. Any fiscal policies that are stimulatory, expansionary, are going to suggest, other things equal, that the Bank of England is going to need to raise rates by more than it otherwise would have had to in order to get inflation back to target. But we don't know the details of the package yet, and that is something that we will come to learn in coming days. And when the Bank of England updates its forecast for us in November, they will no doubt have a narrative around how they see that and where that means policy rates will go going forward.
I'm grateful for your time tonight. Thank you.